Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're starting with a significant development concerning mortgage arrears in Toronto and Vancouver. According to a recent forecast from the Canada Mortgage and Housing Corporation, or CMHC, the arrears rates in these two major cities are set to reach levels not seen in over a decade. This is a crucial issue that could impact many homeowners and the housing market as a whole. The CMHC's analysis suggests that financial pressures, a cooling housing market, and ongoing economic uncertainty are all contributing factors to this anticipated rise in delinquencies. While mortgage arrears remain relatively low by historical standards across Canada, Toronto and Vancouver are facing unique challenges. The abundance of listings and a shortage of buyers are leaving many homeowners in these markets with limited options to sell and avoid falling into arrears. Mathieu Leberge, Senior Vice President of Housing Economics and Insights at CMHC, highlighted that Toronto and Vancouver are in a different situation compared to other cities. The lack of market liquidity, along with the increasing financial strain on homeowners, is expected to cause a sharp rise in arrears rates over the next year. This is a stark contrast to more balanced housing markets like Calgary, Saskatoon, and Halifax, where mortgage arrears are expected to remain stable. Adding to the complexity, the CMHC report stresses that the full impact of rising interest rates and inflation may not be fully felt until later this year and into 2025. This is when many Canadians will face the challenge of renewing their mortgages at higher rates. The report forecasts that at least 1.05 million mortgage consumers will face renewal in 2025, likely at significantly higher interest rates than when they originally contracted their mortgages. The Canadian labor market is also showing signs of strain, with weaker job growth and a rising unemployment rate, currently sitting at 6.5%. RBC economist Nathan Johnson argues that a weakening labor market may pose a greater risk to Canadian households than the upcoming wave of mortgage renewals. This is an important perspective to consider as we evaluate the broader economic landscape. In response to these challenges, the CMHC is calling on the mortgage industry to support homeowners who may be struggling, particularly as mortgage renewals increase in 2025. They emphasize the importance of reaching out to a mortgage professional at the earliest sign of trouble. Mortgage professionals are equipped to help homeowners navigate financial difficulties and offer solutions such as mortgage payment deferrals, extending amortization periods, and adding missed payments to the mortgage balance. The situation in Toronto and Vancouver should be a wake-up call for both homeowners and the financial industry. By staying informed and proactive, we can better manage the challenges that lie ahead. As always, it's crucial to have open communication with your mortgage professional who can provide guidance tailored to your specific situation. The mortgage market is experiencing an interesting development as 3-year fixed rates have dropped again, even though bond yields continue to climb. This is a curious situation, given that bond yields typically influence fixed mortgage rates. The current economic climate has many watching closely, particularly with U.S. President-elect Donald Trump's policies potentially affecting inflation and trade, which in turn could impact Canadian mortgage rates. Despite these uncertainties, some relief is being felt in the mortgage sector. The leading nationally advertised 3-year fixed rate has decreased by 15 basis points, now sitting at 4.09% for default-insured borrowers. However, it is worth noting that by shopping around, you might find a broker or banker willing to offer an even lower rate, possibly around 3.99%. For those with uninsured mortgages, the rates are noticeably higher, with advertised 3-year rates at 4.64%. However, do not be misled by these figures. Many bankers and top brokers are offering discretionary rates in the low 4s, though these rates are not publicly advertised to avoid triggering competitive undercutting. On the variable rate side, Alterna Bank is currently advertising a rate of 5.05%. For high-ratio mortgages, which are those with down payments of less than 20%, Pine Mortgage is offering an even lower rate of 4.75%. Analysts expect these rates to fall further, potentially by another 25 to 50 basis points, when the Bank of Canada executes its fifth rate cut of this cycle on December 11th. It's an interesting time for the mortgage market, and it's essential for consumers to stay informed and actively seek out the best rates available. The competitive environment among lenders can lead to advantageous opportunities for borrowers, so do not hesitate to explore your options. Let's delve into the topic of Canada's looming mortgage renewal wall, which has been a subject of concern for many. According to Robert Kavchich, a senior economist at the Bank of Montreal, the upcoming wave of mortgage renewals, while certainly a challenge, should be seen as a modest headwind, rather than a full-blown crisis for most Canadian homeowners. Over the next 2 years, more than 4 million mortgages are set to renew, with a significant portion of these facing higher interest rates than when they were initially signed. Particularly in 2025, about 1.2 million renewals will occur. Despite this, Kavchich believes that several factors will enable homeowners to manage these changes effectively, even though higher rates may limit their discretionary spending. One key point Kavchich highlights is the stress test that many homeowners underwent when securing their mortgages back in 2021 or 2022. These individuals were generally tested at rates around 5.25%, despite locking in rates as low as 1.5%. This means they demonstrated their ability to handle higher payments if necessary, which is reassuring as rates renew at higher levels. Interest rates, which had peaked between 6% and 7%, have now retreated to about 4%, with expectations that they might decrease further by 2025. This trend is likely to alleviate some pressure on homeowners, even though renewed mortgage payments will still be higher than what many are currently paying. Additionally, banks are anticipated to assist clients by extending amortizations, thus mitigating the increase in monthly payments. Another factor working in favor of Canadian homeowners is the increase in income levels since they originally secured their mortgage rates. This rise in earnings could help offset the higher costs associated with mortgage renewals. While monthly payments could increase by 20% to 50%, most Canadians are expected to adjust by cutting back on non-essential expenses like dining out or vacations, rather than experiencing severe financial distress. It's important to note, however, that younger and lower-income families might face more significant challenges with these increased payments. On the other hand, wealthier households may not feel much impact from the higher costs. Overall, this situation is likely to lead to a period of reduced consumer spending, which could slightly slow the Canadian economy in the short term. Kavchich points out that the impact on discretionary spending will likely be temporary, easing by 2026. By the time we reach 2027 and 2028, the effects of this renewal wave should have largely dissipated. Meanwhile, investors who purchased properties during the low-rate period with intentions to flip or rent might face tougher times, potentially needing to offload properties as the financial calculations behind their investments no longer hold up. Today, we're diving into the intriguing world of open banking and how it's set to revolutionize the mortgage landscape in Canada. Open banking is a concept that's been gaining traction around the globe, and it's poised to have a significant impact on how Canadians manage their mortgages and financial services. Essentially, open banking allows bank competitors to access your financial data through secure means, which can open the door to finding better mortgage deals and rates for consumers. This shift is particularly noteworthy in Canada, where the mortgage market operates differently from our neighbors to the south. In the United States, about 2/3 of mortgages are funded through securitization, which involves pooling mortgages and selling them to investors. Here in Canada, however, the situation is reversed. Deposits primarily fund mortgages, with the Big Five banks controlling a staggering 90% of these deposits. This dominance means that anything threatening their deposit base, such as open banking, is a critical risk to their business model. The advent of open banking means that consumers can permit financial providers to access their data to find better offers and move money more efficiently between institutions. This newfound mobility is a game changer, as it allows consumers to avoid leaving their funds in accounts with major banks that might not offer competitive rates. The trend towards online banking is evident, as seen in the closure of 215 bank branches over the past 5 years, according to the Canadian Bankers Association. Open banking is already presenting challenges to traditional banks, with challengers like Wealthsimple and EQ Bank offering attractive rates on checking-like accounts. For instance, Wealthsimple has nearly doubled its assets to $50 billion, reflecting a growing willingness among consumers to shift their funds away from traditional banks. This shift has significant implications for mortgages, as 56% of Canadians currently obtain their loans from the bank where they hold their deposits. If banks lose these deposits, they may struggle to secure mortgage clients. Moreover, if deposits start to flow out, banks will need to rely more on wholesale funding options like mortgage-backed securities and covered bonds, which are far more expensive than zero-interest deposits. This could narrow the funding cost gap between large banks and their online competitors, ultimately affecting loan pricing. Open banking also promises to make mortgage processes quicker and more efficient by facilitating easier data sharing between institutions. Imagine using an app to get pre-qualified for a mortgage in mere seconds, thanks to seamless data integration. In addition to streamlining processes, open banking has the potential to reduce fraud by connecting lenders to accurate and unalterable financial data. This increased transparency and efficiency could significantly enhance mortgage competition. However, despite the potential benefits, the rollout of open banking in Canada has been slow. RBC Capital Markets. Banking analyst Darko Mihelic suggests that it might take 3 to 5 years before we see widespread implementation. While the big banks may not be facing an immediate existential threat, the pressure is on for them to innovate and compete more aggressively for consumers' business. As open banking gains traction, we can expect a more competitive landscape that ultimately benefits the consumer by offering better rates and services. This is an exciting development, and we'll be keeping a close eye on how it unfolds in the coming years. Desjardins is forecasting a slowdown in rent inflation across Canada over the next few years. This prediction aligns with the government's decision to reduce immigration numbers, a move that aims to address the housing affordability crisis. The report anticipates that a rising unemployment rate and weaker population growth will contribute to this deceleration in rent price increases. Currently, rent inflation is outpacing the rise in home prices, with rental accommodation inflation hitting 8.3% in the third quarter of this year, the highest rate since the early 1980s. This surge has been partly driven by a high number of non-permanent residents, such as temporary foreign workers and international students, who are more inclined to rent. Permanent residents, upon their arrival, also tend to rent initially. The federal government's recent announcement to decrease immigration targets by 20% and reduce the number of temporary residents is expected to slow or even reverse Canada's population growth. This shift should subsequently reduce the demand for rental housing, easing the pressure on rent prices. However, the Desjardins report notes some uncertainty regarding the implementation of these immigration policies. If population growth slows more rapidly than anticipated, rental demand will decrease, potentially easing price pressures. Conversely, if population figures align more closely with the Bank of Canada's outlook, sustained pressure on rent prices could continue. Regionally, the effects of slowing rent inflation will vary. Provinces like British Columbia and Ontario are expected to see a slower increase in rent inflation. In Alberta and Saskatchewan, rents are projected to slow the fastest due to the cyclical nature of their economies and rental markets. In contrast, Quebec may continue to experience elevated rent inflation. The report also highlights that the number of renting households has risen significantly across Canada, meaning that rapidly rising rents impact a large segment of the population. While the anticipated slowdown in rent inflation is a positive development, Desjardins warns that any improvements might be temporary. Long-term solutions require substantial increases in housing supply and policy efforts to enhance affordability in both rental and ownership sectors. Today, we're turning our focus to the Toronto Regional Real Estate Board, commonly known as TRREB. Recent research indicates that a significant number of TRREB agents aren't actively involved in home sales, which is quite revealing given the current market conditions. According to David Fleming, a broker with Bosley Toronto Realty Group Incorporated, over 43,000 TRREB agents were credited with one or more transactions in the past year. However, what's striking is that more than 14,000 of these agents were credited with exactly one transaction. This information emerges as TRREB braces for its first year-over-year membership decline in decades, amidst what many are describing as challenging market conditions. The real estate market in Ontario is currently experiencing a slowdown, with many realtors opting for retirement or facing potential job loss if the demand for housing continues to decline. The situation is indicative of broader trends affecting not just the real estate sector, but also other industries facing similar challenges. For instance, we've seen companies like RioCan and Nissan making significant workforce reductions as part of their restructuring efforts. This reflects a larger economic narrative where various sectors are adjusting to a changing landscape. In Canada, real estate agents, like many other employees, are entitled to full severance pay if they lose their jobs due to downsizing or business closures. This is a crucial right that ensures financial support during transitional periods, and it's applicable to both full-time and part-time, non-unionized workers across Ontario, Alberta, and British Columbia. For real estate agents who might be classified as independent contractors rather than employees, it's important to understand your rights. Tools like the Pocket Employment Lawyer can help determine if you should be considered an employee, which might affect your severance entitlements. Severance pay can be substantial, potentially covering up to 24 months' worth of wages, depending on factors like age, length of service, and role within the company. This can include not just salary, but also bonuses, commissions, and other forms of compensation. It's essential for agents to know they have up to 2 years from the date of termination to pursue their full severance pay rights, regardless of any deadlines imposed by employers. As we navigate these challenging times, it's vital for those affected to seek professional guidance to ensure their rights are fully protected. The real estate market, like many other sectors, is going through a period of transformation, and staying informed is key to managing these changes effectively. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder: Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your home ownership goals. Catch you next time, and stay informed with the latest industry insights.